today. And it's hard to believe that we're already towards the end of the third quarter of 2019. And of course, this is our third quarter 401k educational webinar, where in today's topic we're going to tackle is one that obviously I think most people find important, and we find very important here with a lot of the planning we do with our 401k plan participants and clients, which is retirement income planning. So many times when we're speaking with people and we're working with clients, people are focused on growth, which obviously is an important component to anybody's financial plan. But just as important as growth, in fact, maybe even more important, is looking at where income's going to come from when at one point you are retired. And we are in a point now where we are not seeing what we used to call our grandparents' pension anymore. So traditionally, many years ago, and I know with my grandparents, you'd work at a company for 30 to 40 years, and at the end of your working career, whether it was at 65 or whenever you decided to retire, you stopped, you had a traditional pension plan, checks would start coming, and that was primarily one of your big pillars of income planning and retirement. And as we look at the landscape today and going forward, those don't exist in the format that we used to know them. So that when we look at retirement planning, the 401k plan, as you know it, is going to be one of the biggest pillars that you have to help you produce the income that you will need to live whatever lifestyle you want to live when eventually you get to the point when you're going to stop working. For most people, it's going to be one of the three legs of the stool that we're going to talk about in a few minutes, and Chris is really going to do a deep dive into. But it's going to be a huge part of that stool of income for you whenever you're in retirement. There's a few other pieces as well, but what we're hoping that clients won't be relying on is just one leg of that stool. You don't want to be relying on one leg of the stool. Hopefully, you're going to have more legs of that stool that you can pull from retirement so that you can dictate what type of lifestyle you want to live in retirement, and that lifestyle isn't dictated for you. And so that's what we're going to dive in today. We're not going to take too much time, but we do want to get into some of the details and hopefully provide some really timely information for people to help with their planning as they're going forward. And as we say, here's our team here. This is our 401k team here that's dedicated at Bayntree to working with all of our plan participants. So again, we always say if you have any questions whatsoever, general financial planning questions, questions specifically about your account or how your account works with other retirement plan vehicles that you might have in place or are looking to put in place, whether you want to find out more about your personal level of risk, how to optimize your account, anything that we can be of help with. Obviously, there's no cost for any employee to be able to call us and utilize some of our services to be able to do that. We're here for you, so we urge you to access our team whenever you need to, because we're here to help. So anyway, that's just a quick, in case, a lot of people talk with us, but they don't actually see who we are. Just some quick pictures so you can put faces to names. We urge you via email, whether it's phone, or even if you want to stop by our office here in Scottsdale, or when we're at other parts of the valley, you're certainly welcome to do so. So I'm going to turn over to Chris to talk about what we call the three-legged stool of retirement income, and he's going to jump into those pieces there and provide, I think, some really valuable information. So Chris, take it away.
Hey, everybody. Again, this is Chris Roger here with Bayntree Wealth Advisors. I'm one of the financial advisors on the team here, so I work hand in hand with Brian, Renna, Jess, and Jonathan for overseeing your 401k plans. And like Brian talked about, traditionally, you think of the three-legged approach to retirement, and I've highlighted those three here with Social Security planning, retirement savings, and your employer-sponsored plan. Now, all of these things can change, right? And one of the things that Brian touched on already with employer-sponsored plans, those are going to be your pensions, right? When you retire, traditionally you work for the same company 20, 30 years, and then you retire and they give you a pension. Unfortunately, those type of plans aren't as welcoming as they have been in the past, and not many people have pensions. And we do a lot of Social Security workshops here in the Valley, and we always take a quick poll on how many people have pensions in the room, and usually it's about 10 to 20% of maybe 30 people that have a pension. So what we're seeing is the trend in retirement planning is those pension plans are really going away. So if you are fortunate enough to have a pension, that's awesome. That's great news to hear. You can use that in conjunction with Social Security, which is something else that we'll talk about today. And obviously we can't guarantee what the system's going to look like down the road, but for a lot of our clients, we anticipate them being grandfathered in based on what the rules are today. So we know what the rules and the laws are today. So that's what we have to work with. So Social Security, if you've been paying into the system, it will be there for you in some capacity. And I'll talk a little bit on some of the changes they're looking to implement to ensure that it is there. So looking at, okay, well, if you don't have a pension, what's the best way to maximize Social Security? And then the other part of your retirement income, or the third leg of your stool, is going to be what you personally save for retirement. And for a lot of people, one of their biggest assets is their 401k, right? Because you're deferring money from your current income into this plan, but then most companies out there are going to match you at some sort. So you're picking up free money if you're adding to the 401k plan. So what we really wanted to cover and let our clients and participants of the 401k plans know is the fact that we really help specialize in how to make a game plan with all of these different pieces that can be a part of your retirement puzzle, to say. So we look at, so what are some reliable forms of income for you in retirement, okay? We talked about pension. You know that you can't outlive your pension income. You're going to get that paycheck until you pass away. Sometimes individuals use annuities for a guaranteed income stream. Now, annuities have definitely changed in the past, and sometimes they can be very beneficial if they are used correctly for a retirement plan. And if you are one of those individuals that don't have a pension, sometimes people use annuities to think of it as you creating your own personal pension. So even though you're not having one through your employer, you could look out and on the annuity space, what is something where I could invest so maybe some of my own retirement savings that later on can generate me an income stream that I can never outlive. So, and then Social Security, for now we're going to put that in the reliable column. Again, we don't know exactly how Social Security is going to change moving forward, but for now, it is a pretty reliable cornerstone for income.
Yeah, and we get a lot of questions on whether Social Security is going to be there for a lot of younger people in the future. And our opinion, and again, it's only our opinion, is that it will be there in one form or another. Now, when you get full benefits and what age you can access full benefits, that may change or get pushed back, or maybe benefits will change a bit. But we do believe Social Security will be here in one form or another. It's just, what age will they be access to that, and what will the benefits be?
Yep. Spot on, Brian. And then we look at, okay, so you have your reliable or stable sources of income, and then you look at what's your variable income. You look at your IRAs, maybe if you worked for a former employer and you rolled your old 401k into your own individual retirement account. You can invest your IRA however you'd like. And obviously, whatever you invest in, you want it to perform well, but not every investment performs the same. It depends on how much risk you're taking. So you look at IRAs and 401ks, very tax efficient for you today. Later on, when you take that money out, you're going to be paying taxes on it. So that's another piece that fits into this full income plan for retirement that not necessarily a lot of individuals we see factoring into their own sort of planning. And then this is where maybe some tax exempt type of strategies could come into play, where you have some tax-free type of benefits, whether it be through a Roth IRA or your Roth 401k if your plan allows for that. And then also maybe you just have some investments that are not held in IRAs or 401ks that you're investing on your own as well. So all of these things are variable because no one can predict exactly what they're going to return for you and what type of income and dividend you're going to get. So we talked about one of the big trends in retirement planning is this decline in pension plans here. So you can see back in the early 80s, right, almost everyone had a pension. And fast forward to 2011, right, you can see less than 20% of people have this type of guaranteed income from their employer. Because what happened was employers looked at, well, we can essentially take the risk off of the company and put it onto the employees, which means that you have more responsibility to save and contribute to your retirement. So they looked at why don't we push that risk off to the employee. So that's one of the big reasons. So you're seeing this decline, and that's in regards to the invention of the 401k and how that came about. So that is one of the more prevalent trends that we're seeing is this decline in pension planning.
Yeah, and one of the big differences there is that when you looked at those older defined benefit pension plans, it was pretty easy to determine that when you hit a certain age of retirement, what your retirement income was going to be. And maybe you had a choice to elect it at 65 or 67 or 69, but normally it didn't matter when you really elected it, you could determine what that income was. And now the reverse is true. What we know now is what we're putting into a 401k plan. And we know maybe if, most companies have a match of some sorts, maybe the company is helping fund your retirement plan as well. But we ultimately don't know what that balance will be when you retire, because it's going to be based on how long you're contributing for, what your ultimate rate of return is over that time period, and eventually when you retire. So there are some variables that create an unknown. So it kind of flipped the script. We don't know when you're going to retire. We can't determine the amount. We can determine what goes into it and help you hopefully build that balance so that when you get to retirement, you've got a pretty healthy balance. But we don't ultimately know what that balance will be.
Yeah, and another thing to consider too, with the fact that people are living longer every year with medicine, technology, and so forth, that risk of potentially running out of money is a concern for a lot of people. And with that decline in pension that a lot of individuals used to have that don't have today, it raises the importance of having that sort of income plan to plan. Well, what if you do live to age 100, 105? We've seen that. So you need to prepare for it, because you don't want to be in a position where you're still rocking and rolling, but there's no money left over. So we want to help you avoid that position.
Right. I always say my grandfather had a famous saying. Unfortunately, he's not with us anymore, but it was, what was the definition of eternity? And to him, the definition of eternity was the day my money runs out to the day I die, which is not the version of eternity we wish for anybody. So that's part of what we do here, is hopefully help people avoid that definition of eternity.
Yep, absolutely. And piggyback off of that into, okay, well, with Social Security, if you're working, you're automatically paying into Social Security. So we specialize in Social Security planning. When's the best time to turn it on? Should I turn it on early? Should I delay? How's my benefit taxable? All of these different things that come into play. So how your Social Security benefit is determined is based off of a couple things. Well, number one, it's based off the average of your highest 35 working years. So if you've been working for 40 years, they're going to look at the top 35 working years, not your most recent 35, your top 35 working years, okay? And the other thing, you can start collecting your own individual benefit as early as age 62. But every year that you take your benefit early, you get a reduced amount. And then I'll touch on, with Social Security, if you're still working and you have earned income, not income from real estate, not income from a pension, not income from any dividends from stocks that you owned or bonds that you own, but if you're still working and you have W-2 or earned income, and you collect your Social Security benefit early, meaning before your full retirement age, you may potentially have a reduced amount, or you may not even get anything. So that's something where a lot of people say, hey, well, I don't know how long it's going to be around, so I'm going to take it real early. Well, some people, it does make sense to take it early, maybe if they're not working or if they haven't built up enough retirement savings, but more times than not, it usually makes sense and it pays for you to delay. So if you're 5, 10 years out from retirement and you want to have a better idea on, well, when can I actually retire, we encourage you to go to the socialsecurity.gov website and create your own Social Security profile. And this will give you a couple pieces of information here. It'll give you your benefit that you're entitled to at age 62, and it'll give you what's called your full retirement age, your FRA. That's very important. That is your full benefit that you're entitled to receive without any sort of earnings restriction. For almost everybody on the call, it's going to be between age 66 and 67, okay? Then it's going to give you, well, if you delay until age 70, what's your maximum benefit going to be? So 3 very important numbers to look at when you look at Social Security planning. At age 62, what's your benefit? At your full retirement age, your FRA, what's your benefit? And then at age 70, what's your benefit? And then from there, you can at least look at the beginnings of, well, should I take it early, or I plan to work till 68, so I'm not going to need Social Security? Or if you're going to retire at 62, does it make sense to turn it on? And this is part of what we look at as income planning for retirement, because you think throughout your working career, you're working and you're trying to build your assets as much as possible. So you want your nest egg to be as big as possible before you retire. But now you get to this point where I have my nest egg, and now I don't necessarily need to build it as big as possible. I need to use it for income to live off of and make sure I don't run out of it. So understanding what you're doing on the investment side determines directly and ties directly into what should I do with Social Security, right? Because if you turn on your social, that means less you have to pull from your investments. But this jumps into the next point I wanted to discuss with, as you can see on this slide here with Social Security, if you start at age 62, you get a 25% reduction on your benefit. And I talked about this FRA, this full retirement age. And for almost everybody on the call, it's going to be between 66 and 67. Okay. And when you look at your Social Security benefit statement, it'll tell you what your full retirement age will be. It could be 66. It could be 66 and 2 months. It could be age 67. So that's what this number is here, this full retirement age. That's what this is here. So the earlier you take it, you can see you have a 25% reduction to your benefit. Okay. Now, if you take it at 62, you get this reduced amount from the full retirement age. Your benefit will increase a little bit every year. Historically, Social Security increases at about 2.5% a year. But if you wait these next 4 or 5 years, then you get your full amount. You see here, this zero, you don't have any sort of reduction at all. The other thing as well, I talked about is you turn your benefit on before your full retirement age and you have earned income, you're subject to what's called earnings limit or a clawback. And basically, if you make over about $17,600, if you make anything over that, Social Security is going to take back 1 out of every $2 you make over that. And if you have additional questions on that, feel free to reach out to me or email me on that. But once you reach your full retirement age, this FRA here, there is no earnings limit. So whether you make $20,000 a year or you make $200,000 a year, once you reach your full retirement age, the Social Security is not going to claw back any of your benefits. So you can get your full benefit without giving any back because you're making too much money. And then you can see the benefit of you waiting to age 32, you have a 32% increase compared to your full retirement age. So if you look at all the way from 62 to 70, right, that's quite a jump. So every year you wait, you could see this benefit is increasing by 8% every single year. Now, I don't know where rates are going to be in the future. I know where they are right now. And if you closed your eyes and thought of an investment that you're guaranteed to not outlive, that is very tax efficient because 15% of your Social Security benefit will always be tax-free no matter how much income you make, and you can't outlive it. If you close your eyes and you describe that type of asset, that's a pretty good asset. So we want to make sure we're maximizing that. And where interest rates are right now, if we know Social Security is going to grow 8% every year, we can't guarantee your investments are going to grow 8% a year. So sometimes it makes sense to bridge the gap with your investments and let Social Security grow. So these are all things to just consider when you are looking at building your income plan for retirement.
Yeah, and there's an additional piece of complexity to this that's beyond what we're going to go and do in this webinar, but you can always call us and ask us, is what happens. Many people are married, so you have the ability to get what are called spousal benefits. And when you can elect those spousal benefits, when it makes sense to do that before turning on the other spouse's income, that is something that we can walk through if people are trying to make those decisions to kind of go through some of the what-if planning. It's too much to go into this webinar, but we do a lot of that type of planning with couples. So if you have questions about, I've heard about spousal benefits, when should I turn mine on, when should my spouse not turn theirs on, you can absolutely call us and we can certainly help you and walk you through that.
Yeah, I mean, we could do a whole webinar just on Social Security. There's survivor benefits, there's disability benefits, there's ex-spousal benefits. So there's a lot of different things that you can do. So if you have specific Social Security questions, just feel free to shoot me an email. I'll be happy to jump on a call with you or get you the information that you need. So next, I wanted to transition, and you think back earlier, we talked about those 3 legs. We talked about the pension plan, defining pension plans, how those are really going away. We talked about Social Security as being the second leg. We look at the third leg as your personal retirement savings. So a lot of times what we see, if an individual maybe isn't going in and making changes to their investment inside of their 401k, or they're not working with an advisor to help them with their 401k, a lot of times what we see is they're invested in what's called a target date fund. Okay, what a target date fund is basically whether you're in, and we just used Fidelity because Fidelity is a popular 401k platform. So there's tons of different target date funds there, but basically how a target date fund works is the fund looks at your date of birth and it looks at your estimated retirement age. So this person is estimated to retire in the year 2040. So every year, the closer we get to 2040, the more conservative this fund is going to be, right? So right now, we're 20 plus years away. This fund is going to be pretty aggressive because it has a lot of time before we get to 2040. Now, every year in the year 2038, this 2040 fund is going to be pretty conservative because it's only 2 years away from this estimated age of retirement. So one of the things that we look at is, well, number one, is that something that you want? Do you want your investments to slowly become more conservative over time? It may be a good thing if this isn't necessarily your wheelhouse or somebody else isn't helping you. But the drawback with the target date funds is that, number one, it may not be specifically in line with your investment goals. But number two, we see that these types of funds don't really have a lot of diversification. You don't necessarily have your investments spread out, right? You have this example client has their $10,000 401k all in one particular fund, right? And good rule of thumb, you usually don't want to have your retirement assets all in one mutual fund or one stock or anything like that. So what we look at, and you can see the probability of return here over the next 6 months, potential 15%, 16% to the downside with 22% to the upside. Now, on 10 grand, if you're down $1,500, might not be that much, but if you have $500,000 in there or $100,000 in there, a $15,000 loss could mean an annual income stream for you. What if you needed $15,000 a year in income from your retirement accounts? Now, are you necessarily comfortable with that type of risk, right? So these are things that we look at with the variable portion of your income plan for retirement that we need to think about. So one of the things that we help clients with is, well, can we diversify the 401k plan? So we looked at the 2040 fund was a heavy equity or heavy stock portfolio with not a lot of bonds. So you see this risk number here, risk ranging from 1 being the most conservative. So think of money at the bank. It's not invested in the market. It's not going to lose money, right? Your risk with assets at the bank are eventually, if rates come back up, they might not keep up with inflation. So it's not risk-free, I would say, but there's no market risk with money at the bank. And then 100 is going to be the most aggressive, right? So if you had everything in your retirement account all in one particular stock, that would be very aggressive. So with this, what I wanted to help illustrate was the fact that we can still maintain an aggressive type of allocation here, but you see how we reduce the risk a little bit? So we reduce the risk from 16% down to 13%, but we only sacrificed 1% on the upside, right? And the reason why this is so important is because if you can spread your investments out, so you don't have everything all in one particular fund, it gives you the opportunity to take advantage of asset classes as they outperform other asset classes. And what that means is last year, cash was the top performing asset class. 90% of asset classes lost money last year. It was one of the first times in market history that happened. The year before, in 2017, let's say U.S. stocks were the top performing asset class. And the year before, there was a different top performing asset class. And what I'm getting at here is no one knows every year which asset class is going to perform the best. So that is why you want to spread out your retirement account to have a little bit of different asset classes, because we know one of these assets are going to perform the best. But when you have everything all in one particular fund, you're missing out on these other types of investments or assets that can outperform.
Yeah, and I think an important point to note is to springboard off what Chris said, is that usually the same asset class doesn't perform the best 2 years in a row. So we find many 401k participants doing is looking at last year's numbers saying, okay, this one did the best, I'm just going to keep using that. And what you're doing there is chasing performance and usually never catching it, because that fund that performed great 2018 isn't going to be the one that's tops in 19. You need to have a different mindset when you're building your portfolio so you can catch the one that's going to perform the best in 19.
Yeah, and a good rule of thumb is to understand the risk associated with each asset class. And I'm sure it's not news to you guys. More risk, more opportunity for reward, right? Less risk, less return, or less reward. So when you have a better understanding on the risk level of each asset class, then you can build your account based on risk and not necessarily just looking at which account did the best last year. So that's something to consider, very important, especially when you're going to start using the income, using your assets for income. Now, one of the other things that we wanted to look at was tax planning for you guys. So right now we're in sort of the golden era for taxes. So if you look back in the past, at one point the top tax rate was about 90%. So if you made $100,000, guess what? You paid $90,000 in taxes. Probably wouldn't be too happy with that. So what are some things we can do today with the top tax bracket being much lower than what it was in the past? Okay, and a big part of that we look at is we don't know where taxes are going to be moving forward. So if you plan on retiring 5 years, 10 years from now, and if there is a big tax change, you want to make sure that you have assets that are going to be very tax efficient for you. So with traditional 401k plans, anything that you put into the plan, you get a tax deduction on today, and it helps save you with taxes today, but you have a partner in your 401ks and your IRAs, and your partner is Uncle Sam. So if you want to keep more money in your pocket and dish out less to Uncle Sam, you have to look at other types of strategies. Now, some 401k plans offer what's called a Roth option inside of the 401k plan. The Roth option, you don't have the opportunity to get a tax savings today, but later on when you go to retire, you can pull out that Roth portion of your 401k tax-free. So I don't know where taxes are going to be in the future. I don't think Brian can guarantee where they're going to be in the future, but if they do increase, you want to ask yourself, where do I want my assets to be? Do I want them to be in taxable investments or tax-free type of investments? So that's another thing just to consider. We talked about the three-legged stool, but you can't forget about your business partner, Uncle Sam, right? He's always going to be there, and you have to plan accordingly for it. So from our end, I hope you found this information valuable, and if you don't know exactly how much risk you're comfortable taking, or if you don't know if your 401k maybe it has too much risk, or you're not sure if you're taking on enough, or if you have specific questions on Social Security planning or tax planning, definitely just reach out to me and let me know. There's no cost for a phone call, or if you wanted to sit down, our main office is on Scottsdale Road in Lincoln here in Scottsdale, but there's no cost to use us. It's complimentary because for any participants in our 401k plan. So you can head to our website, Bayntree.com, if you wanted to go through a risk questionnaire to get your risk number. But again, really today was just focusing on things to consider when you're helping build or when you're considering building an income stream for retirement.
Right. And so again, we like to say it's not always what your accounts are growing at, it's what's your income going to look like in retirement. So anyway, we hope everybody found this valuable. And if there's any topics that people would like us to tackle, we're always trying to pick topics that we think are appropriate and will provide value. But if there's a topic you want to hear about or you'd like more information about, feel free to shoot us an email or give us a call, let us know, and we'd certainly love to tackle that at one of our future webinars. So we hope this helped. We're here to help you again. So like Chris says, feel free to use us as much as you can because that's what we do as part of the advisory service to your 401k plan. So hopefully everybody's going to have a wonderful fourth quarter. We'll be speaking with you throughout that quarter and certainly at the end of that. And again, if we can be of service, that's what we're here for. So thanks for your time. We appreciate it, and we'll look forward to hearing from you soon.
Thanks, everybody.